Hi, Warriors. Let's have a great week. Who's up for a great week? Give me a Y. And hello, Alexander and Mary and Sinatra and whoever just cleared their throat.
Good early morning, Dale.
Hey, Kman. Can you guys see my...
Welcome to May.
Good. Can you see my charts?
I see it loud and clear.
Okay. I want to start with this before we get to the markets. Everyone in the community knows how much I respect the work of the partners, Steve and Stel and Blake, and the amazing team. Grega and Andre, Leandro, Paulie, and then there's amazing Amanda. Pretty good team. I think I've covered everyone, but I have to say that you guys, you and Ryan, are a tremendous addition. I've been watching you guys and talking to you guys, and your feel for the market and being tacticians in the market, and also that you really care about traders and doing your best to help them avoid the pain that everyone goes through, that you guys have gone through. And that just proves the law of attraction, and that you guys really, I have a lot of respect for your work in a short period of time, and really think this is the best team on the net. And you rounded it out with flying colors. So just wanted
Thank you very much, Dale.
Yeah, I just want to let everyone know that, may be new or, have been listening to you guys, that you'll give traders an edge in the chat room, and while they're going through assessments, and even if they're not, just if they're trading their own money, that you guys work hard and care.
It's really fitting because we have the best coach on the net as well, right?
Oh, I wanted to also change my title from host to anchor. Anyway, but and I was telling my wife, as a host, I feel like I should have some type of napkin over my forearm and asking you guys if you want a cocktail. But anyway, I wanted to make that statement, and let you guys know that you're appreciated, and we're a great fit for coming in here, and like jet fuel to our rocket ship.
Rock and roll.
Okay, so here we go. Fed week. I mean, that's the elephant in the room, followed by NFP, and markets are lower again. S&Ps looks like they're going to go for that low here. I think it's 48. Yeah. So I guess the question is, does the Fed have enough cover to say hike, and we're going to pause with the lower GDP, or will the hawkishness prevail? One bad GDP print.
Yeah, it's if you put it all together, it may be a little bit of a difficult call, but in my opinion, the negative GDP, when we drilled down, was more due to
trade,
the federal spending and stuff going down. The consumer was still doing pretty okay in a part of the component. So I reckon that's where, after an initial scare, the dollar still came back and did well. To me,
that's really a problem from what I read about the report, that it was, a lot of it was all of our imports and lack of exports. It was a trade balance.
Yeah,
so
the trade balance.
So the strong dollar is starting to show up in earnings reports as being a headwind and taking charges for it. Does the Fed think the dollar is too strong? And I know they say, well, that's a purvey of the Treasury, but I'm sure they pay attention to that.
They're not going to like it, that's for sure.
Come again, Stelios?
I said they're not going to like it, that's for sure.
They are not going to like a too strong dollar, but are we in this are we in their transition? You know, we had this since May, June last year. We had this transition from going uber dovish, and then they started to change their tactics and their approach, and now they are in this what we can qualify the uber hawkish side of things, saying that they are going to hike whatever happens. Maybe it's too early for them to start to change already again. They haven't even started quantitative tightening, right?
Yeah,
I agree. I don't think there is enough out there for them to consider changing their tune. At least not yet.
I think they will go on for a few months, and then, if needed, then we change again. But they have to hike to only to be ready for the next downturn. They have to. The window is there. They have to.
Okay, so I think that's in the cake. They're going to hike. It's just the language, that.
I think the major importance here is how aggressive do they tighten?
Yeah.
How
you think there's a chance for 75
away from the punch bowl?
75 to Wednesday, or is that the meeting? Is it Tuesday, Wednesday?
I honestly think they will go 50s, but in rate hikes, and that's okay because that's baked in. Look at the 2-year, 3-year, 5-year, 7-year. They're all pricing in enough hikes. The rate hikes are, in my opinion, not going to change too much to risk right here and now. But the quantitative tightening of things, how fast will they run off the balance sheet? Because that's really taking liquidity away. That is going to be key, I think, for equity markets and risk.
Okay.
Yeah.
All right. So silver sure looks like it has its eyeballs here on the lows that we made last year.
Yep.
Right here.
Absolutely.
Doesn't it look like they're going to gun for them?
And you know there's going to be stops below there.
Yeah.
Quite a few.
So there's a 200-week moving average around 2010. And gold holding up much better. I've seen counts that the gold-silver ratio could trade up towards 89 or so during this period. So definitely it was a pretty strong week here. So maybe it's going to take a few weeks or a month to get there. But the gold-silver ratio is saying, especially if you're a silver bull, that you may want to wait until this peaks. What do you think?
Yeah, it's definitely a possibility. We're getting close to these lows now in silver. As you said, gold is trading a lot better. I think the problem is commodities in general are dropping last few sessions, and silver is an industrial metal. We've talked about it a lot, so it gets affected. Look at copper. Yeah, there you go. Copper is near those lows as well. And, the more the dollar strengthens and the more yields rise, the more dangerous it is for commodities to break. The question is if or when they break, where do they go? Where do they turn? Good question. I think with the inflation that we're seeing, I would be a buyer of dips. Obviously, if we do get some kind of massive event, some kind of black swan event, anything goes. But I think with the way things are going, dips should be bought. We do have the problem of China with the lockdowns, and there's videos circulating now from this is Shanghai. I can't remember which cities, but huge cities where they've been locked down for 5 weeks or something like that, and people are just they've just had enough. So the China issue could be huge because that will be demand destruction in a big scale, and that's going to be bad for commodities. But as I said before, I think that this, in my opinion, this would be a buy the dip opportunity.
Can you imagine they're asking for the keys to people's houses and locking them in from the outside?
Are you kidding? I didn't read that. Really?
And in the meantime, look at what's happening in the China and the South China Sea with all those ships. I've seen. I don't recall where I saw it over the weekend, but I've seen those radar pictures of how many ships are waiting just in sea to do something, to load or to offload, and it's horrible for right now. I think it's very risk averse. What's happening as we speak right there.
Yeah.
Yeah.
So yeah, China, the big
Yeah.
yeah. So they dread. Go ahead.
No, I was just going to say before I forget, speaking of the Fed, we talked about the Fed before. We have the Fed and the Bank of England this week. Fed expected 50, Bank of England expected 25. I agree with Kman. I think it's way too early for them to change their tune. Yes, GDP was negative, but they want to get as much as they can in so that they have ammunition. And also stocks are dropping, but I don't think they're anywhere near their, let's say, pain threshold. So I've said for a while, I think somewhere around 3,500
Exactly.
the S&P is
Look
going to be. Sorry.
Look at that.
Yeah, there you go.
200. Yeah. Oh no, weekly 200 is right down there.
Yeah. And look where we were pre-pandemic. I think the Fed could pull the string or could pull the rubber band until we reach pre-pandemic levels, which are also around there, no?
Yeah, they're up
yes.
There, right there.
Yeah,
right there.
34.
I think 34 is
yes.
As long as we're above there, because they've said in some interviews that valuations are high, not the level of the S&P, but the valuation of the individual companies was high enough for it to weather rate hikes. So I think as long as we are above 3,400, the plunge protection team might be asleep.
Okay.
Yep.
All right. So we'll see. I think there might be a face ripping rally after the Fed for, just because.
And good morning, everybody.
Go ahead. Hey, Blake.
Hello, Blake.
Hey. I want. Well, first of all, Dale, I was kind of working through some charts when you said your very nice comments a little bit earlier. So I just want to say thank you for the nice comments. It's it's such a pleasure having our team here every day, and it's good to hear your voice every day. You're so you're always on time. You're always here. We all have our occasional days that we are, things happen, but you're always here and you're always a constant with the ForexAnalytix team. So
thank you, Blake.
It's great having you here. You're talking about the S&P. I just want to make sure that everybody sees how.
Grab it. Your neckline's going to come into play.
Yeah, we got a couple of views of the S&P going on. Everybody that's been on this webinar forever knows this chart. This has been a very, speaking of constant, it's something we've looked at quite a bit over the last several months, knowing that there's this big head and shoulder pattern is playing out, or trying to play out actually. And this is more of like the near-term technical view where, we start looking at like where key like level resistance are intraday, that type of thing. But I just want to measure for everybody, just so everybody sees here that the target for a head and shoulder pattern is 3,400. So I know I heard you guys mentioning just a moment ago 3,400 a couple of different times, and that is a logical target. And Benedict in our chat room, he's, by the way, if you guys don't know, we have a lot of traders that have been in our chat rooms for a long time. And I'll just give you an example. Like this is our chat room here, just so everybody can see it. Benedict, who is BW right here, or B-dubs, we call him. He's been part of our community for years and years and years, even before we had ForexAnalytix. He was in my community prior to that, and he's been targeting 3,400 as well with a harmonic type of pattern setup. So we're all looking at basically the same thing, kind of different, getting confirmation different ways, but it's dangerous. We are heading into a seasonal part of the of the year where you get I know it's the old adage, selling may go away, and you might say, well, Blake, that hasn't really worked in recent years. Let's not forget that, over the last 12, 13 years since the financial crisis, that when the real estate market collapsed here in the United States, and, Lehman, collapsed and everything else, we've had unprecedented liquidity come from every central bank around the globe for so many years. And we are in a period of tightening monetary policy. And that's something that, so many like I say generations. Well, actually, I could almost say it like a whole generation of traders, really over the last, 10, anybody who's been in the markets for less than 12 years, they've never even seen anything other than a bull market. If you look at the S&P from back here in 09, like this is 13 years of a massive bull market. Yes, we had a COVID spike, but the COVID spike just realized that incident provided, in retrospect, yeah, the market pulled back, and that was a great place just to be long, because the market, every central bank added gobs of liquidity to the market and just propelled the market even higher. So we have to work off all of this excess right now, and we're going to get a mean reversion in the markets, in my opinion, and it's happening right now. We're in process of it. So I think you have to be really aware of the time of the year that we're in. It is, time of the year where people will, exit their, long positions in their portfolio. They'll tidy up some positions, and they'll head to Greece and go visit Stelios, right, Stel?
Yeah.
It.
So anyway, I just now we have a big week this week. I don't know. I know you were talking about the Bank of England and the FOMCs, Stel, but don't forget the RBA is tonight too.
That is very true. Yes.
Yeah, and Kman, you've been updating some charts in the Aussie dollar right now, and I know the Aussie's near some pretty critical support here. I've been targeting the Aussie dollar down here around the 68-cent level for a while. I really want to be long the Aussie. I really do. I don't want to be long today, and I don't want to be long where we're at. I really want to be long down here, where this green line is. You can see that there. But do you have any views on the RBA today?
Oh no, not really. I don't have any positions in the Aussie. I think we are, of course, we're like close to important levels on the Aussie dollar.
Yeah.
But I'm not even sure with FOMC ahead that I want to trade Aussie versus dollar. I might be looking at trading if the RBA goes hawkish and says, yes, we are going to raise aggressively. I think stuff like Euro, Aussie yen, Aussie Swiss, if anyone wants, but I don't trade Swiss very much.
I've gone there before. I've gone there before.
Could be stuff to be again long off, like Aussie versus the lowest yielders.
Yeah.
But if they stay a bit weak, I think Euro 68 may be looking us right into the eyes very, very soon.
Yeah, I don't disagree, and I'm long. I'm actually short Aussie, long I'm looking at the Euro Aussie right now. I happen to be long this pair at the moment, and I've been wanting to add for a long time. Because I've been building this long position since 2 weeks ago, or. And I'm positive in it right now, but I'd really like to, play it on the long side, maybe back up to the 200-day moving average. I'm willing to even add to this position, up at these levels. I'd love to see it, rally a little bit here, but obviously we have with the RBA tonight, it's going to be interesting to see if we get a hawkish hike. They are at 0.1% right now.
There's anything expected from 15 to 50, and they are very divided to the opinions of the specialists.
15 to even 0.40. To bring the RBA back up to a quarter point or a half a basis point, but they could. Remember, it's not all about, and I want to make sure everybody's really aware of this. It's not all about the headline rate either. You have to imagine like the RBNZ, they could hike rates, but they could front load it. I know that term has been thrown around a lot over the last couple of months, but it could be a we're going to get the RBA back up to, the rate back up to half a basis point, but we're going to do it quickly right now and kind of see where we're at. We're going to reassess, what's happening right now. I mean, you have to imagine with like these moves that we're seeing in the dollar, CNH. Let me pull it up really quick. That move is China just
impulsive.
exporting. I'm sorry.
Impulsive.
Yeah, it's very impulsive, and that's China's policy right there of exporting some of their pressures out of China by weakening their currency and pushing those pressures out to everybody else. So it is I think the RBA has got to be very careful because they're going to be really sensitive to what China is doing near term, and we've got to watch the slowdown that we're seeing in not only China but the Asia Pacific region and the rest of the world is for that matter too. So the RBA is going to be really interesting tonight.
Yeah, can I just add just 1 second on this? It was very, very interesting what we've seen the past months, how Aussie and Kiwi have been moving. If you look at when the war started in Ukraine, when Russia invaded Ukraine, Aussie and the Kiwi were the best there was on the planet and was strengthening against everything because it's the far from my bet risk that they got positive for them, as long as China did not start to let yuan weaken. And since then, we have seen exactly the opposite. So they were the best currencies when the war in Ukraine started. But then as soon as China started to move and let their currency weaken, Aussie and Kiwi have been struggling because the world is realizing that things are not going that well elsewhere either.
Yeah, very, very good point. Very good point.
I like your green line there.
Yeah, because this was like, let's remove let's go to where where Kman
it was the best false breakout.
Yeah, it was like a false breakout, and then everybody's got we all talk about inflation and these inflationary pressures, but we also have to be aware that we could have deflationary pressures come our way too. A lot of people think that, we're going to be in a stagflation environment. That's like the common theme right now against, with a lot of economists. We're going to have, sustainable or sustained high inflation, slower growth. But how about if we get like deflationary pressures that are coming because, you get China, weakening their currency, so they can kind of, again, they're pushing the pressures outside of China and bringing them everywhere else. So you have to think about that as we move forward. And I think the Aussie dollar is at risk of taking a bit of a beating here. And I'm going to be in the camp of trying to buy the Aussie on a dip, but then you have to take a look at other currencies. Like take a look at this dollar CAD. I mean, the dollar CAD, we had this, big, and it's in blue, so you can kind of see it here. We had a false breakdown in the dollar CAD, as far as, through this wedge, looked bearish, didn't fulfill downside. Now, when you get a false breakdown, the risk is that we, break higher. Then you factor on top of that crude oil that's just hovering around 100. And, we sit there and look at crude and say, well, why isn't, in this environment, why isn't crude higher? I mean, with everything that's happening with, Ukraine, Russia, and, and inflationary pressures, why isn't crude, trading at 130 or 150 a barrel? And it's not. And, and I wouldn't even come close to pointing the finger at the U.S. administration right now, but it should be higher, and we're not. And so if crude starts to come under pressure, the dollar CAD could rally. You take a look at the dollar Norway, the NOK, or the crown has really come under pressure here. We could break through 10, on any sort of upside swing and downside pressure in crude. So we're seeing a pretty big move brewing here in the currency market that, it's all like suggesting some, risk off. Now, I wanted, since we have just a few minutes before Dale has a great interview coming up, and with Julian, I'm really excited to have Julian here, Julian Brigden, we have the dollar yen, which just completed here. I'm going to pull up a cleaner chart. The one that I sent out our traders this morning. Let me get over there to really quick. Where is that chart exactly? Is it this one? Yeah, it's this one. Okay. So you can see nice, clean AB equals CD move, bullish, pennant, whatever, however you want to look at it. We are sitting around the 130 level. And I know we've all been sitting here going, man, this is, extremely bullish, extremely bearish yen. I can't find a reason to be buying yen right now. And sometimes when you can't find a reason to buy something or sell something, that might sometimes be the best time to be a buyer. And I'm not saying that we should be buying yen right now, but we've gone really far, really fast. And in an environment where you see a little bit of risk off, is it possible that the yen, I'm asking you, Kman, and anybody else who wants to chime in here, is it possible that the yen catches a bid for, a nice risk aversion bid? Is that possible?
I think it's happening. The dollar yen will likely reflect less because of the central bank divergence. But look at all the yen crosses; they're all well lower than their spike highs. If you look at euro yen printed 140, it's 136.5. If you look at stuff like Canada yen printed well over 102, it's trading at 100.5.
Yeah.
Stuff. I think there is already a reflection of this risk-off environment in the yen pairs, and which causes a pause in the dollar yen on the other hand.
Yeah, I mean, like I look at the euro yen and this is a great example that you brought up. This one was on my radar from last week, and even though I'm not short yet, I have to say that the rejection at the 618 retracement, the fact that we can't break higher, how many people have been trying to trade this thing to the long side, thinking, hey, we're gonna just sell yen and buy some euros because the euro is such a good value down at these levels anyway. Euro dollar's holding 105, so why not buy the euro yen? If we come breaking through like 134, this is where I'm gonna really start. I might even actually leverage up a little bit and get short, some euro yen if it breaks through 134. I haven't touched it yet, but it is something that I'm really considering, given the fact that it's not really participating in this rally. So, or in the yen sell-off as well as you'd think. So that's interesting. And it's something that I am obviously keeping an eye on. Now, I'm going to ask you this, Stel, what do you think about the euro here? Do the euro's at 105? Are you a buyer, or do you think that euro is going to parity, or maybe to 103 or something? What do you think?
I think I'm not going to divert from what I said at the beginning of the year. Obviously, as I said before,
no, please do. I want to see
no,
you be a flip-flopper.
Not yet.
Flip-flopper.
No,
Flip-flop on us.
I wouldn't be buying it ahead of the FOMC, that's for sure. Okay. But I do think that I do think that there's so many factors which are now one-sided that make me very nervous whenever this happens. So basically, we have the Fed pricing in 50s after 50, and the ECB a lot less. We have the Russia-Ukraine conflict going on, which we all know when that gets settled one way or another, that's going to give a boost to the euro. And I just think that risk-reward, it's really not, it doesn't look good at all, at least in my eyes, to be short the euro dollar. Now, in the short term, obviously, can we head to parity? Well, yeah, of course we can. But I think the odds are stacked the other way now. And I'm not talking about tomorrow or the day after, the week after. Yeah. I'm talking about, looking maybe towards, to year end or something like that. So, that's my view. It's not changed. And yeah. To answer your question,
so I wouldn't be. You're going to stick with those thoughts and those ideas. Okay, yeah. I'm actually I'm considering that this week, especially given we have the FOMC this week, and the market is obviously pricing in a half a basis point. We're going to see where the Fed's going to lead us after this week. but I am going to probably take a counter trend trade and start selling some dollars post FOMC. So that's my kind of my plan right now. I'm trying to figure out how I want to do it technically, but I'm and where the entry points might be, but that's kind of like my master plan going into this week. But that doesn't mean it's going to be that way going into Thursday. A lot can change between today and Thursday and or did I say, is it Thursday or Wednesday? Did I say Thursday?
Wednesday.
I think
it's Wednesday.
Thursday is the Bank of England.
Yeah, Thursday is the Bank of England. Sorry, but a lot can change between now and Wednesday. I mean, we've got just a couple of days here, and I will tell you this: that's one of the benefits of being a trader is being able to switch gears a little bit. But hey, I just want to say thanks team for your thoughts. I know we are at the point where we're going to have a great interview from Dale. I'm going to pass it over to him just for a second, but I just want to say, for those of you that do not know, try out ForexAnalytix. It's $1 to try it out for 10 days. Get involved in our community. We have like one of the most active trading communities. I mean, this is a holiday in a lot of Europe. And this is when I got up this morning, right here. And you can see just, right there, I say good morning. And this is just the general chat room, not the trades room, not the Spanish chat room, not the news and research or the macroeconomics room. This is just over the last hour and 10 minutes or so. And you can see it's very active, even for a holiday. So, a lot of like-minded people in there, and take advantage of it. It's $1 for 10 days. Jump in, grab the mobile app so you have all of everything at your fingertips. And if you want to try to figure out a way to get ForexAnalytix included, you could actually, join the trader funding program. Just check that out on our website. But I don't want to take any more time away from Dale. Have a great interview, Dale. Team, thank you so much for being here today.
Thank you. Have a good week.
Thanks, Blake.
Good luck, everybody. We'll be back here tomorrow. If you're a ForexAnalytix subscriber, remember in 45 minutes, we're going to do the morning edge. So we'll see you there.
Okay, Dream Team. Julian Brigden, welcome back to F.A.C.E. How are you, Julian?
Thanks, Dale, for having me on the show. Sorry, I was on mute for a second there.
That's okay. It's great to have you back. There's a lot to talk about. I went over took a look at some of your stream and Twitter. And before we get to some of those things, I just want to introduce Julian. Julian's is up in, heaven on earth in Vail. Is it heaven on earth for you, Julian?
Well, actually, I'm in Chicago at the moment.
Oh my God, you went back to hell. All right, you're in Chicago now? I grew up there, so...
I've been spending my time, Dale. It's the end of ski season.
Okay.
So not so much to do up in Vail at the moment.
Okay. For me, I would just hide from the heat and the humidity, but, you have a nice perspective from both places, Chicago being really a hub. I mean, that's where I learned the business. I used to run orders when they traded currencies on a chalkboard, Julian. So,
I can relate to those days. Not quite that. I wasn't quite in the smoke signal days, Dale, but yeah, certainly early days.
So, the big question is, of course, are your expectations with consensus on the Fed for this week, Julian?
Yeah, I think so. I think my sense is I think people, you occasionally get these sort of commentary that sort of read, Powell as some sort of politician, and he's not really, but he is very concerned, I think, by the Fed's reputation, and particularly with the American people in aggregate, as opposed to any one political party. And he's concerned with this angst that you're seeing now amongst the American people around inflation. And I think he's decided to sort of gird his loins and kind of go for it. What that quite takes, we will see. I think the big thing that, Dale, that I think people continuously underestimate is this idea that it's only about inflation. This is not about inflation now. This is about slowing an economy down, which is growing above trend, You know, that means broader, tighter financial conditions. I mean, I think, you know, the equity bulls constantly just sort of want to find a way where, oh, well, you know, inflation will come down in the second half of the year and, you know, everything will be great and off we go. You know, we can rally again because the Fed won't have to hike. It's just not how it happens. It's almost impossible to tighten financial conditions, which, you know, I think we discussed last time I was on the show. You know, there's a broad metric of things that go into financial conditions. So there's 2-year yields, sort of 10-year yields, the dollar, credit spreads, and equities. And you look at across the board, and you sort of say, you know, we've done some sort of calculations. You say, so where do we need to be, right? If you've got to get growth back to trend, and I would dismiss the last GDP print as aberrative, dragged down as it was massively by exports, and also by some, you know, inventory.
So the strong dollar is a problem. I know I underestimated this dollar move. Is the Fed baking that into their consideration? I mean, if they
I mean, look, it's just part of the mix, right? I mean, I think I don't think yet. I mean, the Chinese move intrigues me. Yeah, that one intrigues me. I mean, we caught it from 647, I want to say 646.
Okay, nice buy.
Yeah, that was a nice buy. We'd had a stab at how to going it a couple of times, Dale, because it just looks completely out of whack. If you look at it against the basket, and you look at it against the euro, and so we're actually, even though I'm a long-term structural dollar bear, I'm not sure.
Right.
I'm definitively not sure. I mean, if anything, this is the classic way that you move into a crisis is what we refer to as the napalm run. Okay, in the dollar.
All right. I remember Robert Duvall loved napalm.
Yes, exactly. Love the smell of napalm in the morning. Exactly.
Yeah, it reminds me of victory.
Yeah. Well, this is usually how dollar bull cycles end.
Yeah. Okay.
And it's a kind of, because a rising dollar is disinflation. It's tightening financial conditions for a bunch of countries across the world. And this is kind of how it typically ends, is you get this vicious squeeze. And it's the napalm run is when you get a risk off move, Dale, and the dollar rallies.
Yes.
Okay. Why is that a napalm run? Because it is the denominator of most of the assets that we trade. Right. So think if you're owning gold and you need it to be a store of value, right? If the denominator is rising in absolute terms, the dollar, okay, then in euro terms, gold can fall in nominal terms. In euro terms, it can be unchanged, right? That's the point. So it becomes really, really destructive because your denominator's rising as the underlying, in a risk-off environment, as that underlying asset is falling. So it just compounds the effect, right? Copper's already falling, and oh shit, the value of the dollar's going up too, so I have to sell copper even more, right? So the napalm run literally leaves you left unconstrained with a bunch of charred bodies and smoking holes.
Yeah, so I mean, people... Yeah, going over Niagara Falls in a barrel, right?
Exactly. I mean, it is a total disaster. Now, the Fed has always intervened at that point, right? Has always come in, and they've either offered swap lines or whatever. And the fact is, I don't think people know this, but after 2020 was quite interesting because within a matter of weeks, the Fed did something which in, say, the global financial crisis has taken months to do, right? It offered swap lines and repo facilities to all the central banks across the world.
Right.
right? And it had never done that before. It'd taken months and months and months for it to happen. I mean, yeah, they'd offer swap lines to, you know, the Bank of England, the SMB, and the ECB, you know, kind of the inner circle. But you could forget, you know, Indonesia or China or all these other guys. Well, not in 2020. And they've actually left that facility permanently open now, the repo facility. So I think the odds of a true napalm run are reduced, but we're still in that sort of risk off dollar rallies, because this is the Fed tightening, and the way this typically ends is something breaks. Could be here, could be overseas, right? Could be Japan, could be I don't think it's Europe, could be the US equity market, and then the Fed goes, oh, sticks their hands up in the air, mea culpa, backs off. And that's when the dollar goes.
Isn't this already broken?
I mean,
the bond market. I mean,
I think the bond market. I think there's a decent chance
of a rally.
No, I think that there's a decent chance that the bond market is truly broken. I mean, when I look at charts, Dale, I like to look at over long time periods. I like to look at logs. Julian. Yeah, I like to look at log charts, right? Okay. So if I look at log charts for, you know, and the sort of core of the problem has been, you know, in the 5-year sector, in the belly of the curve.
Okay.
So I don't know if you let me share a chart.
Sure, I could do that. I'll stop sharing, and you go to the bottom, and there's a green button. Share screen. Got it. Beautiful.
Use Zoom all the time. There you go. So this is the log chart of 5-year yields. This goes back to 1981, so it's contained 40 years worth of bull market in treasuries.
Yeah.
You know, look, it's a few weeks. This is a 40-year chart. I'm not going to, you know, hang my hat on it completely. But that looks, you know, pretty much from 2s all the way to 10, you've broken.
Okay, it looks chaotic. First the decline and then the rebound just as quickly. And the acceleration of both moves are bigger than anything you see going back to the late 70s.
Correct.
So, you know, there's some, definitely some cracks in the structure and liquidity.
Look, short term, you know, we come a long way. I mean, I was noticing copper's starting to break down, right?
Yeah.
You know, that gold copper ratio is not a bad metric for treasury yields. I mean, you know, it's one that I've used for a long time. You know, Jeff Grundlack used it. Obviously, you know, he's a
guru.
A guru, exactly. You know, and so, you know, do we get some sort of slight reset? I mean, I've actually gone long one bond market, and that's the UK, and it's not long dated. I've done short dated. I've done the short dated swaps they call Sonias, which have replaced euro sterling, which used to be, you know, like your IBOR, the short end interest rate contract. And the reason there is, as I do see the consumer, they don't have the wage growth in the UK that we have here in the US. So that people, and they didn't have the degree of stimulus that we had here in the US. And so
that's a proxy for the euro pound long?
I mean, God, I'm just touching the euro.
Because, you know, the euro's made successive new lows without the euro pound.
I know, but yes, maybe. But the trouble is with Europe, it's just so toxic, right? I mean, you can't. I mean, look, you and I talked before, and we thought, you know, there's a decent chance that euro is making a low, and then what happens? Well, you know, Ukraine. I mean, really. So you can't really touch it at this point. You can't really touch it. I mean, I was going through stuff this morning, and you too have true stagflationary signals building in Europe. Now, whether it persists, you know, but they're going to get hit by European manufacturing, particularly German manufacturing, is going to get hit by the lockdowns in China. You know, they're a huge export market for Germany. They have insane price pressures. I mean,
Yeah.
Insane price pressures.
What's
right?
going to happen when either Putin cuts off gas deliveries or Europe says we're going to ban imports from Russia?
Well,
and
then
can
you're
that happen?
cutting off your nose to spite your face. But I sort of struggle with that one. I mean, I don't, you know, I struggle with the logic. Would you shoot yourself in the head voluntarily unless you are truly suicidal, which I don't think these guys are? So I have to think they come up with some sort of solution that keeps things ticking over. Maybe I'm wrong. I mean, it'll depend a lot, but they've come out this morning and said they can't find a deal, right? I mean, in part, mostly because of Hungary, who said, no way, we're not going to, we're going to pay for stuff in rubles. But I think, you know, the Austrians have said they're going to pay for stuff in rubles. So,
yeah, it seems like the whole world is kind of lining up with Russia, India, China, Brazil. And you know, that's geopolitical, but I want to get this out of you because you know, people are amazed that I remember what we talked about months ago. But I remember in our first interview, we were trading here in silver. And you said, I'm going to back up the truck if we get to $19. And that turned out to be a temporary low. And we had one more failing rally. Well, it looks like they're going to take out these lows now, Julian.
Great.
Would you be interested, even during a napalm run, of buying silver in the low 20s?
Yeah, if I can get it in those levels, that's the level that I would start to get. I would start to get interested. I look, you know, it's one of those things, Dale, that I think you take a stab as it falls, right?
Yeah.
But you only take a stab because silver is, it really is the negative dollar trade, right? If you look at a long-term chart of silver, I mean, it really is profound how dollar sensitive this beast is. And let's see if I've got the chart. Yeah.
And that Euro model, you know, Julian, I gave up on, you know, so we're probably close to a top in the dollar. But what made me finally capitulate was we no longer had weekly divergence in Euro.
Right.
It blew out the divergence in the dollar on the daily. So, you know, I have nothing.
You just can't touch this. You can't touch this for the moment, Dale. I mean, look, you know, it's just, look, there's, you know, I used to work at a shop for a while and we had lots of geopolitical guys, and 99% of the time you could just, it was utterly irrelevant for markets. Markets would just look through what was going on, you know, whether it was, you get a little wobble around Gulf War or the Iranian Revolution or Gulf War II or, you know, whatever. And you would just, it would be an issue for 2 weeks and then you'd move on.
Right.
Ukraine is so much bigger than anything that we've seen. I mean, throwing us back into a new Cold War, you know, trying to deal with all the energy and the food issues that trickle out of this thing. I mean, is that 1% where geopolitics trumps absolutely bloody everything, right? And of course, none of really the geopolitical guys got it really spot on. But when I do look at silver, I think, you know, there's arguably a bit of a trend line that came off the sort of 2002, 2003 lows. I'll show you here if you'll let me share again. Okay. Share. So if you look at this is my classic bubble, right? This is my classic bubble chart for silver. So look just how dollar sensitive it is, right? So this was a dollar high here in 2002, and silver was trading at, you know, under $5, and this is the dollar low, and it's trading at 50, right?
Okay.
So I mean, it is a balls to the wall short dollar trade, right?
Right.
You know, right here, right now. I mean, I think these are the levels that you were talking about down here. That kind of come in the sort of 22, 21 and a half kind of levels, depending on where you want to draw them. Flush out the stops, take them down to this sort of support level here. which comes in at 19 and sort of change. Maybe this trend line. I do think it, we toyed around with it here, but I still think it's got some degree of validity. Yeah, so that would be the levels that I'd try and have the first stab. But as I said, it's the first stab only, Dale, because silver can absolutely kill you. And I'd rather pay up a little bit.
Yeah.
Yeah. I'd rather buy into strength and a trend.
I hear you. You want some confirmation.
I want some confirmation.
Who needs to be the hero, right?
Right, exactly.
Prudence over valor. I noticed that you talk a lot about Kathy Wood in your stream, and she's kind of.
I'm sorry, I can't. I apologize to anyone who's on this. You know
what's amazing though, and it was a retweet that you put out there, where I forgot who it was saying that retail's not broken when she can attract huge crowds wherever she goes, even at a Bitcoin conference.
Oh, Tom Thornton.
She has people that want to do,
my buddy. Yeah,
people want to do selfies with her.
Yes.
So retail's still believing. I guess we have to wait for people to come with cattle prods and pitchforks before we believe retail has given up on.
Yeah, I mean, if you look at the shares,
wants to get off the ark.
And I know you could, some of these go into things, but I mean, the absolute high in the shares outstanding, I think was how many million? Is that 200,000? 0.2, whatever, whether that's 2 million or whatever, I'm not sure. And now we're at 1.88, right? I mean, it's fractional. There's been very little capitulation. Yeah. And, I think it looks like, I think this setup, to be brutally honest, looks like the .com bubble to me in the US.
Yeah. I forgot who it was that set up a negative ETF on ARK.
Oh, yeah. Well done.
Yeah. I think it was one of the guys from that scored on the housing crisis here.
Right.
All right. So, Julian, I really enjoyed talking to you, and you do have a newsletter that people could sign up for.
Yeah, absolutely. So, if you're interested, I mean, the easiest way to get hold of either our institutional product or our retail product, which we do with the guys at Real Vision, is just to contact support at mi2partners.com. And then follow me on Twitter otherwise, which is Julian MI2.
Well, were you out here for the conference in San Diego?
I was, yes.
Oh, next time, let me know.
Yeah, sorry, I didn't realize that's where you didn't realize that's where you were, Dale.
Yeah,
but,
so next time,
it was very good.
It was.
I think I scared a few people, but
I think Michelle Schneider, you scared a little bit.
Yeah, I just sort of said, everyone, we're on the cusp of a rotation in the equity market of biblical proportions, and I think it's getting some, headway now. I think a few people are just getting some support now. But I think that over the last decade, where we've seen tech outperform and commodities and resources underperform to an almost unprecedented extent, I think over the next decade is going to flip 100% onto its head. I think that, and that's what happened during the dollar weakness of 2002 to 2008. Tech underperformed everything.
Right.
And resources outperformed.
Okay, so that's a big picture from Julian Brigden, and what a blessing to be able to have a life partner, be a partner in your business, and not get divorced. So
actually, I did get divorced, but there you go. I mean, we're still friends, so that's good. But there you go, Dale.
What a blast talking to you, Julian. Thank you for your time today, buddy.
Cheers, mate. Bye-bye.
All right. Adios. So that's it today, guys. I hope you enjoyed talking to Julian. I got him to nail down a little bit that he'd take a stab at silver down there. And appreciate you guys being here today and all week. It's our mission to build up and edify traders every day. And that continues in 19 minutes, make it 21 minutes on the morning edge. So if you haven't been in there when they do the bias charts, check it out. And I'll see everyone for Turnaround Tuesday. Good luck. Tread lightly in front of the Fed and get ready to react to the reaction instead of playing roulette. So that's a wrap, everyone. Have a great day. And don't forget, don't just count your pips, count your blessings. Thank you, Mary. To you too. See you, Ronan, Laura.